I think the biggest risk out there is that Powell, who will only be in place until May, that Powell is not, and the other Fed board members are not understanding the deflationary undertow that is beginning to take place here. They are experts in a given technology, and they are generalists when it comes to sectors and industries, because these technologies are converging and they are going to impact every sector, every industry, every company.
We are living through a period of profound market dislocation, a time when traditional industries are under pressure, growth equities are volatile, private credit excesses are surfacing, and algorithmic trading is amplifying every signal into a cascade. Yet beneath what appears to be chaos, a deeper structural shift is unfolding. According to Cathie Wood, this is not merely a cyclical downturn or a speculative unwind. It is the collision between the old industrial order and 5 transformative innovation platforms that are rewriting the rules of the global economy. In that collision lies both risk and extraordinary opportunity. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
Bitcoin is a hedge against inflation and deflation because the chaotic part of this is, and it's ripping through the markets now. A lot of traditional industries and companies, being brought, the whole SaaS space, the disaster, as they're calling it. We think there is merit to that particular one, but I think you're going to see disruption all over the place. Because the 5 innovation platforms that I mentioned are going to disrupt the existing world order. And what does that mean? If these technologies are so deflationary, it's going to be tough for the traditional world that's gotten used to sort of the 2 to 3% inflation, to adjust. They'll have to embrace some of these technologies faster than expected. So the idea of counterparty risk, I think, is beginning to surface. We've seen it with First Brands. We've seen, private equity and private credit, especially, is where there have been a lot of excesses. SaaS, they are too exposed to that. Are we going to see counterparty risk manifest more broadly? If so, Bitcoin, it doesn't have that problem, and so it is a good hedge against deflation as well as inflation. So it's a risk and an opportunity. So there's bad deflation and good deflation. If you look at the government measures, they will tell you today we're kind of stuck in this 2 to 3% range. If you look at a more modern indicator, Trueflation, I think you feature it as well. Trueflation is down to 0.8%. And so it too was stuck in that 2 to 3% range. It is resolving to the downside. And I think it's going to go negative. When I see Pepsi cutting the price of potato chips and Doritos by 15%, I take note. And when I hear Coke saying, yeah, it seems like there's a bit of a backlash against price increases, I take note. Today, the existing home price inflation rate dropped to 0.9% on a year-over-year basis. And we think that's going to go negative. New home prices are already falling on a year-over-year basis. Gasoline prices falling. And then the good deflation is associated with technologically enabled innovation. And the AI boom is massively deflationary. The AI training costs are dropping 75% per year. AI inference costs, so what it costs when you query ChatGPT or Grok, what it costs to answer that, that's dropping 85 to, if you believe DeepSeek, 98% per year. And I think the productivity gains that we are seeing accrue to enterprises, that is going to turn around in a number of ways. One of them could be price declines. So many people think, these corporations are going to simply increase their margins. Well, China is exporting deflation. I know with tariffs, we're countering it, but isn't it interesting that our inflation rate did not accelerate with tariffs? It remained stuck. I think we're going to see a lot of price declines in the future. We have been using the word convergence for a long time I'll give a plug to our Big Ideas 2026, and you'll see a section by Brett Winton, our chief futurist, called The Great Acceleration. And you'll see a sphere in there showing how all these technologies are converging one with another. And at one point in the last, I'm going to say 6 weeks, Elon said, you know what? I think my companies are convergent stories. So we thought it was interesting he used that word. So SpaceX XAI does not surprise us at all. I think he's going to let Tesla run here for a while, because the robotaxi revolution is just beginning. And I do think he wants that story, to become very clear to investors. And it will. He doesn't want to, combine with anything and confuse what's happening here. And as you know, we have very big expectations for robotaxis. We love it that Tesla and Waymo are competing against one another. And we think, the stock, Tesla stock, if you look at it, it's been in a very large trading range for the last 5 years. And I remember the last time I said that was when Tesla was going through manufacturing hell, and there were people out there saying Tesla's going to go bankrupt. There's no demand for these things. It had been in a very wide range for 6 years back then. And I said, the history of long bases like this is they either break out or break down. And we very much think Tesla's getting ready to break out again. And then Elon will have more degrees of freedom.
For years, ARK Invest has spoken about convergence, the merging of multiple exponential technologies into unified systems. These 5 platforms include artificial intelligence, robotics, energy storage, blockchain, and multi-omic sequencing. Within them are 14 distinct technologies, all accelerating simultaneously. Convergence means these technologies no longer evolve independently. AI enhances robotics. Robotics scales manufacturing. Energy storage enables electrification. Blockchain underpins digital ownership and decentralized finance.
What's happening in the last week or so in particular reminds me of the early days of COVID. Nobody knew what to do. And so algorithms just sold everything off except for, the safest stocks, the most cash rich, and cash flow generative companies. And I remember as I was looking at it, it's an algorithmic move taking place in the market and causing a bit of a downward spiral, in innovation related stocks. Now, unlike COVID, we're probably not going to have massive fiscal stimulus in the way that we got back then. So we're not going to come out of this with a big boom, but they're selling the baby with the bathwater again. And so it gives active managers, an opportunity to, in our case, concentrate towards our highest conviction names. I think the biggest risk out there is that Powell, who will only be in place until May, that Powell is not, and the other Fed board members are not understanding the deflationary undertow that is beginning to take place here. And they will not, because they're not looking at the right signals, and because they're looking at government data, which is all, wrong, and based on the industrial age, they could miss this and will be forced into a response when there's more carnage out there. I think that's what I'm worried about right now. I think this is the opposite of the bubble, tech and telecom bubble. Right now, we're seeing all of the beneficiaries of AI, and every stock in our portfolios we have been looking at through the AI lens for actually the last 5 to 10 years. And so we believe we have the beneficiaries in our portfolios. But there's so much confusion out there on AI that, it's baby out with the bathwater, as I just said. And then you have this overlay of the policymakers once again being late. A lot of people in the crypto market and in our markets are technical analysts, and they use the 200-day moving average, 200-week, and they see it break. So, there's an algorithmic, technical move taking place here. And, as I always say to our team, truth will win out. And we definitely are on the right side of change. And we believe we are in the right companies, that will, benefit mightily from not only the AI revolution, but the convergence among these technologies. When you think about the way traditional research is set up in traditional asset management, it's set up incorrectly to understand what's going on here. It's set up by sector or industry or sub-industry. Many companies have 5 healthcare analysts, 5 consumer analysts. In the world of innovation, the right way to look at the world today is by technology. Involved in those 5 platforms are 14 different technologies. We have set up our analyst responsibilities by technology. So they are experts in a given technology, and they are generalists when it comes to sectors and industries, because these technologies are converging and they are going to impact every sector, every industry, every company. What's so interesting? Many people are asking, is this just a hype cycle? And, should we pull away? I don't know if you've seen the markets in the last couple of days, but, now algorithms are assuming that AI is going to destroy industries wholesale. This is not what happened during the late 90s. In the late 90s, when Jeff Bezos said, we're going to invest so much more than we expected because this opportunity is so great. And that means we are going to lose so much more money than you, shareholders, expected us to lose. The stock absolutely took off to the upside. Any company saying that today is getting hammered. So we are in a completely different environment. Your question was the various parts of the administration being united. You mean when Kevin Warsh comes on board? Right now, of course, Powell is not at all aligned with Trump. You mentioned dollar devaluation. I don't think that's what's going to happen. Treasury Secretary Bessent, who knows all about currency markets and knows how important they are, is saying a strong dollar is in the interests of the United States. Now, many people look at what happened last year. The dollar went down quite significantly. But if you look at the dollar in a long-term context, just go back to the early 70s and see where we are now. You'll see that the dollar, again, this is relative to other currencies, not relative to gold. The dollar is at closer to the upper end of the range, with the exception of the 85 blowout of the dollar than it is to the lower end. And I think the policies of this administration suggest to us return on invested capital here in the United States should go up relative to that in the rest of the world. What do I mean by that? We've got massive deregulation. This government understands how much we have hurt ourselves relative to China with thickets of regulation, and they're trying to peel those away as quickly as possible. We got a tax cut where for the first time in our tax history, for the next 3 years, as long as the construction of a manufacturing facility starts by the end of 28, during its first full year of, or during its first year of service, the company building that facility will be able to depreciate it not over 30 to 40 years, but in the first year. So massive tax refunds coming back to reinvest. Where we are seeing tax cuts for the consumer to some extent, certainly at the margin, in, tips and, overtime, Social Security, and autos. So, I think we're going to see massive refunds here in the first quarter. And I think that, the rolling recession that we've been in for the last 3 years, PMI being down negative, for saying manufacturing's been negative for the past 3 years. We've seen housing and got a terrible number today, 3.9 million. We're back to the lows in existing home sales. I think we are going to shift from that to a rolling recovery into a productivity-driven boom.
Markets are confused. Algorithms are reactive. Policymakers may be late. Innovation stocks are volatile. Private credit excesses are unwinding. But structural technological acceleration continues. History shows that long consolidation phases often precede decisive breakouts. Innovation platforms that compress costs exponentially reshape entire industries. Productivity revolutions are rarely linear. They are disruptive, uneven, and misunderstood in real time.